Imagine having one of the most successful investors on the planet as your mentor. I'm talking about Warren Buffett, the legendary Oracle of Omaha, who consistently ranks among the world's wealthiest individuals. According to Forbes, his net worth exceeds an impressive $140 billion. Today, you have the unique opportunity to learn directly from him. Buffett is not just an investor, he is a financial philosopher whose strategies have shaped generations of investors. Since the beginning of his journey at the age of 11, he has adopted an approach that values patience and a deep understanding of the companies in which he invests. His simple yet powerful philosophy focuses on long-term investing and choosing stocks that many overlook. In this video, we will explore 8 essential tips from Warren Buffett that can help anyone increase their wealth and achieve financial independence. These are not just theories. They are proven principles that Buffett has used to build and maintain his fortune over the decades. And you'll find that the last tip is perhaps the most transformative of all. Get ready to dive into the world of investing through the eyes of a master. These tips are practical, direct, and applicable, regardless of the size of your current portfolio. And remember, tip number 8 is a true gem that many experienced investors often overlook. Stay with us until the end to discover this crucial tip that can forever change the way you view investments. Tip 01. Invest in businesses you understand. One of Warren Buffett's maxims, invest in businesses you understand, reflects his preference for staying within his circle of competence. This means choosing to invest in industries and companies whose operations and business models are clear and understandable to you. Buffett believes that by investing in areas you know well, you significantly reduce the risk of unpleasant surprises and are better equipped to foresee future challenges and opportunities. This investment philosophy does not imply that you should avoid learning about new markets or industries. On the contrary, Buffett encourages investors to constantly expand their knowledge. However, the decision to invest should come after a deep understanding and careful analysis. This avoids hasty decisions based on short-term market trends or third-party advice that may not align with your financial goals or comfort level with risks. The practical application of this tip is simple but powerful. Before buying shares of a company, take the time to understand how it makes money, what its competitive advantages are, and what challenges it faces in the market. Read annual reports, follow industry news, and if possible, use the company's products or services. This level of diligence not only helps build a stronger portfolio, but also increases your confidence as an investor as you base your decisions on solid knowledge rather than speculation. Tip 02. Be patient. Warren Buffett often emphasizes the importance of patience in investing, highlighting that true financial success is the result of a long-term vision. He compares investing to planting a tree. You plant a seed today, water and care for it, and eventually reap the fruits years later. This metaphor perfectly illustrates his belief that the greatest financial returns come to those who wait. In a world that increasingly values immediate results, maintaining a long-term perspective can be challenging, but it is essential to replicate Buffett's success. Patience in investing also means resisting the temptation to react to every market fluctuation. Buffett advises against the common habit of selling stocks during temporary lows and buying during highs, a practice known as market timing. He argues that the time you stay invested is more important than market timing. Therefore, instead of trying to predict market behavior, investors should focus on maintaining solid investments for a long period, allowing the intrinsic value of the companies in their portfolio to manifest. Finally, patience is crucial when it comes to seeing the results of your investment strategies. Solid investments can often take time to show their true value, especially in volatile markets or during uncertain economic periods. Buffett himself has faced criticism when his investment choices did not seem fruitful in the short term. but history has shown that his patience was rewarded many times over. By following his example, investors can cultivate a mental fortitude against market panic, staying firm in their long-term convictions. If you are enjoying the video, leave your comment below. I love reading and responding to each one. And don't forget to subscribe to the channel and hit the bell to not miss any content that can transform your financial journey. Tip 03. Seek quality at a fair price. Warren Buffett is notoriously known for seeking quality at a fair price in his investments, a strategy that balances the desire to own excellent companies with the prudence of not overpaying for them. He advises investors to identify companies that not only have a solid market position and competent management, but are also traded at prices that offer a margin of safety. This concept of margin of safety, paying less for the asset than its calculated intrinsic value, is fundamental to avoiding significant losses and maximizing long-term gain potential. Seeking quality involves a detailed analysis of the company's operations, financial health, ability to generate consistent profits, and stability in different economic conditions. Investing in a quality company means putting your money into a business capable of withstanding adversity and capitalizing on growth opportunities. However, this quality must come at a price that makes sense. Overpaying for a good company can still result in a mediocre investment. Buffett emphasizes the importance of calculating the fair value of a stock based on its discounted future cash flows, ensuring that you are not paying an exorbitant premium for future expectations. Finally, this balanced approach between quality and price prevents investors from falling into the trap of choosing stocks based solely on popular metrics or market tips without substance. Instead, it encourages rigorous due diligence and a commitment to fundamental analysis. This not only improves the chances of investment success, but also contributes to greater confidence in investment decisions. By following this Buffett tip, investors can develop a robust portfolio that generates lasting value no matter what the market does. Tip 04. Maintain a margin of safety. The margin of safety is a central concept in Warren Buffett's investment philosophy. It refers to the practice of buying stocks at a price significantly below their estimated intrinsic value, creating a financial cushion against valuation errors, market surprises, or both. Buffett believes that by investing with a margin of safety, investors can protect their capital from significant losses while simultaneously increasing the potential for attractive returns. This strategy requires a careful and conservative evaluation of a company's true value, considering all tangible and intangible aspects that may influence its future performance. Implementing a margin of safety does not mean just buying cheap stocks. It means buying good companies at prices that offer security. For Buffett, this involves a thorough analysis of the company's fundamentals, such as profitability, debt, management, and growth potential, among others. By evaluating these factors, investors can determine a purchase price that not only reflects the company's true value, but also provides adequate protection against market uncertainties. This disciplined approach ensures that the investment is made with the expectation that even if some aspects do not go as planned, the overall investment will still be solid. In addition to reducing risk, the margin of safety also offers an important psychological advantage. Knowing that you bought an asset at a price below its real value allows you to remain calmer and more confident during market fluctuations, which often lead to hasty buy or sell decisions. This serenity allows investors to follow Buffett's advice to be greedy when others are fearful, capitalizing on opportunities that arise when the market undervalues certain stocks. Thus, maintaining a margin of safety is not only protection, but also a tool for increasing portfolio profitability in the long term. Tip 05. Ignore market predictions. Warren Buffett has a skeptical view of market predictions, frequently highlighting that they are little more than speculation. He argues that trying to predict short-term market movements is a futile and potentially dangerous task that can divert investors from their long-term strategies. Instead of focusing on economic forecasts or trying to guess the next big market move, Buffett advises investors to focus on the fundamentals of the companies they invest in, choosing those with solid and predictable business models. By ignoring market predictions, Buffett emphasizes the importance of maintaining a long-term perspective. This approach allows investors to avoid the emotional pitfalls of the market, such as panic during a downturn or excessive euphoria during a high, both situations that can lead to hasty buy or sell decisions. By keeping the focus on the quality and long-term performance of companies, investors can better capitalize on the true value of stocks, which manifests over time and not through short-term fluctuations. Finally, this approach of ignoring market predictions not only increases the likelihood of investment success, but also contributes to greater tranquility. Knowing that the market is inherently unpredictable, investors who follow Buffett's advice are not swayed by daily news or sudden market swings. This promotes stronger investment discipline and a mindset that values sustainable and gradual growth rather than quick and often illusory gains. Tip 06. Build and maintain a concentrated portfolio. Warren Buffett advocates the idea that it is better to have a portfolio of a few investments that you know deeply than to spread your money across many assets just to diversify. According to him, excessive diversification can dilute potential returns and prevents the investor from having a deep knowledge of each asset. Buffett emphasizes that a concentrated portfolio, composed of companies that have undergone rigorous value analysis and have solid fundamentals, can generate much more significant returns. He suggests that investing in a small number of companies that you understand and trust is a more effective strategy than trying to cover every sector of the market. This concentrated portfolio strategy is especially advantageous in times of economic or market turbulence, where in-depth knowledge of the few selected companies allows the investor to make informed and timely adjustments rather than reacting impulsively. By focusing on fewer investments, the investor can closely monitor the financial health and operational performance of the companies, making more informed decisions based on changes in company fundamentals, not short-term market fluctuations. However, it is crucial that this approach is balanced with a clear understanding of the risks involved. Building a concentrated portfolio requires exceptional diligence and understanding of the businesses in which you are investing. The lack of diversification can increase risk, but as Buffett demonstrates, if investments are chosen carefully and maintained with a long-term perspective, they can offer sufficient security and substantial growth potential. This is a game of quality over quantity, where deep knowledge and confidence in your choices are vital. Tip 07. Be averse to debt. Warren Buffett has always emphasized the importance of avoiding excessive debt, both for individual investors and the companies in which they invest. He firmly believes that debts can become a trap, increasing the risk of bankruptcy and hindering a company's ability to operate effectively during periods of economic crisis. Buffett prefers to invest in companies with strong balance sheets, low debt, and strong cash generation, as this indicates that the company is well-positioned to face adversity and seize growth opportunities without relying on external financing. Aversion to debt does not mean that all debt is bad, but rather that it should be managed carefully and sparingly. Buffett often highlights that controlled and strategically used debt can be beneficial, but many companies and individuals fall into the trap of leveraging excessively, which can lead to serious financial problems. For investors, This means it is crucial to analyze the capital structure of companies before investing, preferring those that use debt responsibly and have a strong repayment capacity. For individual investors, Buffett's philosophy is also applicable. Avoiding personal debt means living within your means and avoiding accumulating consumer debt, such as high-interest credit cards. He advises prioritizing debt repayment before making significant investments, as interest charges can quickly consume investment gains. By avoiding excessive debt, both companies and individuals can build a more solid and resilient financial foundation capable of withstanding inevitable economic fluctuations. Tip 08. Reinvest dividends. The last and most important tip from Warren Buffett, which many investors ignore, is the practice of reinvesting dividends. Reinvesting dividends means using the dividend payments received from your stocks to buy more shares of the same company. This strategy may seem simple, but it has a profound and powerful impact on the growth of your portfolio over time. By reinvesting dividends, you take advantage of the power of compound interest, where earnings generate even more earnings, creating a virtuous cycle of exponential growth. Warren Buffett frequently highlights that reinvesting dividends is an effective way to increase your wealth without the need to add more of your own capital. This practice allows you to buy more shares of companies that have already proven to be valuable and profitable, increasing your stake and potential future earnings. Instead of spending the dividends, reinvesting them means you are constantly strengthening your portfolio, increasing both the number of shares you own and the future dividends those shares will generate. In addition to accelerating the growth of your portfolio, reinvesting dividends also provides solid financial discipline. Staying committed to reinvestment ensures that you will not be tempted to spend your dividends imprudently and reinforces a long-term mindset. Buffett believes that this approach is one of the reasons he was able to turn relatively modest investments into a colossal fortune. Therefore, if there is one Buffett tip you should follow religiously, it is this: reinvest your dividends. It is a simple yet extremely effective strategy that can radically transform your financial future. Following Warren Buffett's tips can be the difference you need to transform your investment approach and achieve lasting financial success. From investing in businesses you understand and maintaining patience to seeking quality at a fair price and reinvesting dividends, each of these strategies has been proven over decades. They not only reflect the wisdom of one of the most successful investors in the world, but also provide a solid foundation for anyone willing to adopt a long-term mindset and committed to building wealth. So, which of these tips are you most eager to implement? Leave your comment below and share your experiences and insights. Don't forget to like the video if you found the information useful and subscribe to the channel for more content that can transform your financial journey. Remember, the path to wealth is a marathon, not a sprint. With patience, discipline, and the right strategies, you will be well equipped to face market challenges and reap the rewards of your hard work. See you next time.